G'day guys, Jason here and welcome along to the weekly update, the motivational tips and strategies to get you pumped in the marketplace. Hey, today I want to talk about something I'm very passionate about. When you're a property investor, you never want to have negative or long-term negative cash flow in your property portfolio. And right at the moment, because interest rates are low and a few other things, there's a chance for many of us, if we make the right move, we'll never be negative again. And listen, I want you to stick with me today. I'm going to have to explain a little bit on the board. So I'm going to bring it all together and show you how when you buy an investment property, if you structure it correctly, that property will always be positive cash flow and take care of itself and not take money out of your pocket. So let's get into it. What we're going to do is we're going to talk about a property that we have right now. It's a live property at Positive Real Estate, and it's a place called Townsville. Townsville is a good market. We think it's a nice, strong market. It's not a capital city, but we believe it's a major city for growth and long-term opportunity as a property investor. In Townsville, we can get a brand new property for $425,000. 4-bedroom, 2-car garage, good sort of simple, straight up and down property. And we can get a loan on that property. Most people, if let's say they're buying an investment property, if they've got a good income, let's say 70 grand or more, would qualify for a nice, easy loan to buy that property. 5% loan. So 5% on 425 grand is about $21,000 in interest. On that property, you've got to pay some rates, you've got to pay some insurance, you've got to take care of things with the rental agent. So there's about $3,000 worth of extra costs. So the property is going to cost you round about 25K, 24K, $24,000 in expenses, okay, to own that property. Now let's have a look at what the property rents for. The property rents for $495 a week. Now when you times that by 52, you will get in your pocket $25,740. So that's not bad. So right now we've chosen a good property and it's positive cash flow, okay? Positive cash flow. Now, positive cash flow, let's say by $1,740 is not massive, but it's a great start. It's not taking money out of your pocket, it's putting it back in. But how do we make sure that this situation gets set and make sure that you're not negative cash flow ever again into the future? It's how you structure your finance. I'm going to draw it on the board. It's using an offset account with your investment property. And we're going to have some tax deductions we're going to use as well. Okay, for most people, we end up starting with a house and we have some equity in this house, okay? We go to the bank and we get some money. Most people that we coach set up on this house, whether it's another investment property, but most people it's an owner-occupier mortgage or it's where they live, we set up an offset account, okay? Offset. And what we do is when we go and buy an investment property, let's say we're buying this investment property here, this property now is chucking off positive cash flow of $1,470, and it's going into our offset account. So it's sitting in here. That's every year. Plus, we're getting about $6,000 worth of tax credits back to you. So we're going to put those $6,000 back in here. Now, if you add that up, $7,470 worth of cash flow, extra cash flow now is sitting in our offset account. Now the money sitting in the offset account is actually going to save us some interest as well. Now whatever money we save on the interest, which is the offset account, we tip back into the offset account. What we ask people to do if they want to never be negative again is lock in a low interest rate. Okay, low interest rate, let's say it's 5% for 3 years, and then you save $6,000, $7,000 plus the savings, let's say $7,000, $8,000 a year for 3 years, 3 times 8, 24, and it's in your offset account. Now, if and when the interest rates go back up, you have $24,000 worth of extra cash in here to cover any negative cash flow. Now, let's say the interest rates went back up, let's say to 9%. That would make the property around about $5,000 negative cash flow a year, right? And you'd have pretty close to 5 years worth of coverage for that property. In the meantime, that's been 9 years now. The rents more than likely would have gone up as well. So guys, this is how you use your finance and your positive cash flow and your tax deductions all to make sure as you move forward as a property investor, you don't be negative again. To get a more detailed explanation of that and find out specifically how it might be able to suit your personal circumstance, you need to get along to one of our property investment nights. Our coaches there know how to do this stuff standing on their head. They teach people every day and they love it, and they'd love to teach you. So get along to one of our nights, see if you can't learn a few tips and strategies to make sure that when you go forward as a property investor, you get the most out of it. Until we see you in person, take care. Bye for now.